Good. My video glitched, so hopefully it still works. All right. Good evening, everybody. My name is Daniel Young. I'm the owner and founder of Adaptive Perspective and the Adaptive Perspective social media platforms. And I am back to talk about closed-end funds and overall investment strategy. So this is an unedited video, as you can already see from the issue at the front. Who knows what you'll hear in the background as I film these in my house. I am not a financial advisor. I am a strategist. And I don't speak like the herd. I walk in limited company and sometimes I walk alone. So I don't have many notes for the week. I want to go through the closed end fund list like normal. I want to give you an update on our portfolio and what in our goings on, but I also want to give you some information that's a little bit different than the norm. And that's probably the best place to start. So let me share my screen. So this is an email from Morris Invest. And I stuck it in here because there's just honestly more stuff in my inbox that I want to share right now. Um, so Morris Invest is a real estate company, and they are notable for maybe three or four things. But one, they're notable because it's a real estate company wrapped around the idea of a self-directed IRA and or an SD IRA or a SDIRA, and using that to invest in real estate. Also notable in that Morris Invest has a bad track record. There's a lot of litigation and lawsuits against the company. Rumor has it Morris himself lives out of the U.S. because he's wanted for those lawsuits. And their company, their U.S.-based company, does a lot of real estate work right now in Lubbock, um, which just has a lot of growth. So they build entry-level homes that real estate investors can buy and, and add to their portfolio. Now, I say all that because that's in the emails that I get. But quite honestly, me personally, I'm not going to buy a house through Morris Invest right now. A lot would have to change in order for that to happen because of that track record, because of the litigation, and not every shiny penny is an amazing penny. So I get their emails because it is a great insight into the market. They have great information. They have great real estate information. I just wouldn't buy through them. So I got this email from Morris Invest, and I think it's interesting because it relates to our journey and your journey in the market. So as you read this email, you can pause the video and read it as you go, and I'll scan through it, and it's got information on different aspects of life. But I'm going to come back to that. Yeah, you can call them if you want. Pretty easy to find on YouTube. Um, let's see this. So we all get the inflation bag that impacts everything, and how much inflation there really is depends on how much you believe the Fed or not. So instead of that second bullet, let's look at this. 1.6 million is the estimate currently for retirement needs. Now, hopefully, my calculator also shows up. So that 1.6 million is based on the 4% rule. So if you look at just a basic calculator and multiply 1.6 million times 0.04, that's the 4% withdrawal rule, then you're looking at about 64,000 annual in retirement, meaning you have 160 you have 1.6 million in principal, you're taking out 4% a year, which is not accurate. I mean, I continue to work on my argument for closed-end funds, and I just got off looking at this again, but the number is far higher than 4%. But for argumentative sake, we'll say 4%. So 1.6 million times 4% that you're losing every year in principal is $64,000, kind of like a salary, like that's what you're getting in retirement. Now, the 64,000 is taxable income. So 64,000 divided by 12 is about 5,300 a month, and it's all taxable income. Now, pending on when you start a Roth, pending the age, pending your contribution, pending your return of investment, all of that stuff, you can easily hit 1.6 million in retirement in a Roth. For me to do it, so if I started, we started last year. If we max out our Roth contribution every year, if we hit a 10% ROI, which is possible because we're using closed-end funds and getting those dividends, if we max out our investment every year, if we average a 10% yield return every year, and then we don't pull money out until we're 70, we would have an estimated 1 million in retirement funds. But if you started, say, if you were fresh out of college, it's very easy to hit 1.6 million in a Roth. If you pending your investing platform, if your parents open or if you open a custodial Roth for your kids, to where you can start them with a Roth when they're, say, 16, when they have a job. So when they're 16 and then hand it off when they're old enough, you can really set them on a path to become a multi-millionaire. And the benefit of a Roth is that it is tax-free money. It's notated on your taxes, but so long as you jump through the hoops, it's not tax deferred. It's not taxable income. It is tax-free money. So inside a Roth with 1.6 million invested, and you're not selling your principal on that 4% rule. You're keeping your principal intact. You're living or supplementing off dividends on a with a portfolio that generates 9% a year. It's 144,000 tax-free income every year, which you divide that by 12, now it's 12,000 a month. That's a considerably different tale than the 4% rule. It also means, not that I'm not going to tell you that you don't need as much. I mean, whatever you need. Whatever you want, right? So the beauty of closed-end funds and the dividends and keeping your principal intact, it means that you can retire with less. Now, I'm not saying less is your goal. I'm just saying you don't need a million or 1.6 million in order to retire. Depending on your number, you can retire with less. Um, you can do the math yourself. It's if your goal is to end up with $600,000, right, at 9%, is 54,000 a year divided by 12 is 4,500 a month in tax-free income. So you can easily hit that with 1.6. You can easily blow past that depending on when you start a Roth and when you retire. Uh, and that 4% rule is just not worth it in my standpoint. So let's get to the closed-end fund master. So I updated the master. I need to go through and do a full system update. That'll probably happen this week. Uh, but how it looks on the video, honestly, it's still a bond market. I read an article by Brett Owens that said buy the tech dip, but depending on how your tech stocks have done, or if you own tech stocks, it's not really a dip. It's not like we saw a 10% bubble. I think our one primary tech stock changed maybe 15 to 20 cents. That's not really a dip. Um, and then the next day it blew right back. So, uh, I would listen to the arguments to buy tech dip, but really it's still a bond market. That's really the best place to be. So if we thin out the group this week, um, let's see, BRW's discount increased a little, FCO's discount increased a little, and honestly, I could thin out the list. I mean, we'll take out the non-monthly payers because the goal is monthly. Uh, Pinning your take on premium, um, I can argue to buy these funds in premium because they really don't hit discount. And in buying them close to or better than their 1 year average, you're really getting a discount, but it's still really hard for me to buy premium funds. um, of where we're already invested. In order for us to pick up something different, the difference or the different fund would have to be notably better than where we already are. Um, because it limits the diversification for diversification's sake. Like we already own several different bond funds. Why add another one when we already have several different bond funds? Um, so if it were me, I mean, I would do the same thing. I could thin the list like normal, or I could just be honest and say, based on discount, based on price, based on buy-in value, all that stuff. If it was me, I would pick up 100 shares of FCO. And if we still had money left over, I would pick up another share of HFR or another 100 shares of HFRO. Um, I can make somewhat of a case for a lot of them, but the push currently is still bonds. It's still bond proxies like utilities and energy transfer and real estate, pending cost, pending discount, pending what's already in your portfolio. Um, so instead of saying the same thing over and over and over again, week in, week out, I want to be a little bit different this week and show you what I ended up doing on the forefront of things. So we transferred money around. Um, we took money out from Morgan Stanley and the guy who was shepherding our money, and without saying a lot, and certainly without saying too much, we were not satisfied with our growth. So uh, we're going to do things differently. So the funds in green we bought, and I haven't color coded that in the overall master yet because we're going to make some additional changes. And I'll get into those first. That'll make matters simpler. So I've decided I want to move our funds at Webull into Fidelity as well. Simply well, it's not simple, but uh, because in order to make this as easy as possible for my family to manage, on the chance of something happening to me, and I don't think anything's going to happen to me, but on the chance of anything happening to me, it's much easier to deal with your finances when they're all in one umbrella. Fidelity has a host of platforms and a host of options that are, we'll say they have more options than Webull. Um, I don't know many people talking closed-end funds. I mean, Michael Foster has his retirement funds all wrapped in closed-end funds. Brett Owens talks closed-end funds, and outside those two guys, I really don't know. I don't know of anybody else talking closed-end funds. So it's not like my wife would call Fidelity and get advice, and they would give her advice on closed-end funds. It's not that. But when it comes to advice and overall advisory services, Fidelity has that option, and Webull does not. It makes it easier when all of the aspects of the portfolio are in the same place. So to help not so much improve our management, because I mean whether I'm investing at Webull or investing in Fidelity or with Fidelity, um, it's the same overall. However, it's that survivorship uh, paradigm in a sense of you want to make it as easy as possible for your survivors to take on what you're building. And when it's all spread out, it's a lot harder. So if we can kind of combine everything into the same area, it just makes it easier. So the goal is to move this portfolio into Fidelity, and it would join the portfolio we just made. The additional goal would be to take the Roth and also transfer the Roth. I don't want to sell the Roth. That's a tax nightmare. Um, but the goal would be to transfer the Roth to same account structure, right? Just transfer the Roth to our account at Fidelity, and now uh, this individual fund would merge with this fund. The Roth would also come under our umbrella, And then instead of having all these different tabs, we would still have a Fidelity individual account, and we would still have a Roth at Fidelity, but now it's all at Fidelity. Um, so, of what we decided to do, or what I bought this past week, I decided to go with smaller uh, investments instead of one lump sum. It's partly that dollar cost averaging thing. It's kind of like it's almost like a pride thing. Like I'm going to do this. And the, and I don't know, it's limiting the risk of things. So if we really do see a tech bubble burst, or if we really do see some type of drop in the market, it's a little bit of a hedge against that. But it's also just spreading out the investment over time uh, to get a better dollar cost average. I don't know. Um, but it made more sense to spread it out into smaller amounts instead of just an all in that day. Uh, I think when we bought, the market was neutral. I mean, maybe 3 weeks from now, the market will swing back into extreme fear and we'll get a better deal. I don't know. But that kind of plays into that. Um, we ended up with four funds that we already own. The HFRO, so I look over, so HFRO, HGLB, that bond aspect, and still, it's much more portfolio in a can than it used to be, but I still like the portfolio. BRW, primarily bonds, but other stuff. And then FCO is still really my primary favorite, I guess you could say. But instead of going, like 300 down the aisle, I went 300 on the bonds and then two on the rest. And then we picked up some municipal bond companies. Um, and it's kind of the same thing. Like, why not do 300? Well, these two ought to do exceptionally well. We're kind of at the end of the municipal bond rally, I guess, or maybe like the overall curve of things. Like the best time to be in bonds was about a year ago. Um, Utilities was really 6 months, more like a year, almost 18 months ago. Energy transfer the same way. Real estate is hit and miss depending on which fund you're looking at. Um, and with me being new to the municipal bond forefront of things, it's something that's been on my radar for a while, if you've watched my videos, but it's also, even though they're bonds and even though there's discounts and even though um, the tax equivalent yield thing is, it's a stated yield, but it's also tax equivalent based on your tax return. Since I'm new to all that, I went ahead and trusted Brett Owens, who reports on municipal bonds a lot. Um, and I took his advice in those three. And the funds that I passed by, partly on overall cost, because the goal was to do those smaller investments into the market, but also just it's hard to explain feelings. It's when I honestly, every time I invest, I pray. And uh, I mean, whether this loses me people or not, really, the truth is, every time I invest, every time we do anything financially, especially any major financial decision, I pray about that. And I pray for wisdom and I pray for discernment and I pray for guidance and I pray for it's like, make it obvious. Like, if this is what we need to do, make it obvious. And my uncle gave me really great advice. It was, look, if you have to convince yourself to do it, it's probably not the best thing to do. Like, if you're really struggling with it and you're having to convince yourself it's a really great deal, then it's probably not a really great deal. And that fits into the make it obvious. So I as I went through and did our initial round of investing with Fidelity, I hit these four with, it was like I'm thinking about this, and at the same time there was pushback. And I could argue with myself about why we should invest, but I could also counter argue about why we shouldn't invest. So I decided to pass on all four of these. And I wrote the reasons out at the time. And I'll start with this one because I just read a Brett Owens article about why we should buy this fund, even though it's premium. And I read an article maybe 6 months ago from Brett Owens, he was responding to a different reader of his service who said, "Hey, shouldn't we buy it even though it's cheap? Like it's premium, but it's cheaper on the premium side." And it was, "Hey, I would hold off because we only buy in discount." And it was kind of interesting to see the same guy somewhat change tactics on the market. Now, I'm not saying he's right or wrong. That's not my point. But it's just different sentiment based upon how the market is and also how the fund is. But on my side of things, I honestly couldn't convince myself to buy a premium, partly because I've talked premiums and discounts and focused on significant discounts for so long, but also because that feeling that I couldn't make a winning argument to do it. And then I started really looking at the numbers. And about a year ago, that was really the best time to buy, right? It's as we go through these waves in the market, it's really hard to time your buy. It's really hard to optimize when you're going to invest and time the market correctly. But if I'm going to try to invest our money the overall optimum best way possible, we picked up five bond funds in this portfolio, two of which we already own in a Roth, right? BRW and FCO. And if you want to include HCLB in that, now that's like five and a half. When we picked up five funds, it was really hard to add PDO as a bond fund, knowing that we already bought other bond funds. And it was hard to do it because it was also in premium. Now, it's in discount based on its overall premium. I mean, it dipped about a year ago and it was in discount land, but really outside of that, it sits in premium territory. And it's about on par for its average. I think it's like a cent more. So I could get the argument of why people would buy it. I just couldn't convince myself to do it. And with that, PDT and DNP are both utilities. Uh, or at least part of PDT is utility. The It's kind of the same thing. Like I went back and forth, or I'll do DNP. I went back and forth. I mean, it's a straight utility. I went back and forth on it because it's timing the wave, and we're regardless of how long the tail end of the wave ends up being, the best time to invest in utilities was at least 6 months, if not a year to 18 months ago. So we're on the tail end of that. Now, whether it's another 6 months or a year or anything before they tank again, I have no idea. But it's really hard to buy the premium. Now, in comparison, compared to PDO, PDO is kind of trading on par versus DNP currently is under the 52-week average. It's, I mean, look at for the year low, I mean, it was pretty much break even. It generally trades plus 10% in premium. It's like paying $1.10 instead of a dollar, right? The average for the year is 8%. That's like $1.08 instead of a dollar. So at $1.04, it's currently on discount, relatively speaking. That being said, I still couldn't buy the premium. But with that, they pay a consistent dividend. They do. They pay a consistent dividend. So if the price dips with their consistent dividend, the dividend yield actually goes up. But so long as the dividend stays the same and the price keeps climbing, your dividend yield goes down. So it's cheap in the sense of it's cheap compared to the discount, but as to the price itself, it's actually more than it was 6 months to a year ago, and it had a slightly wider discount. So I passed on it. PDT is also utilities, and it's got the triple like it's got the right parameters of things, right? Like it meets the metrics, but it's I'm trying to optimize my investment as I screen these out. So, does it meet the target metrics? Yes. Is it a monthly payer? Yes. Is it a 9% or above yield? Or can I justify buying an 8% yield or lower, like these? Like these three are all sub 8 yields. But if you look at the taxable equivalent yield based on our income bracket, it's quite a bit higher to where the three averaged together is almost 10% on a tax equivalent yield scale. So even though there's, mid sevens, it's still maybe 2.5% higher. So could, would I be willing to buy something that was below eight? That was harder. And I can, I could argue for it, right? I'll let you read that. I can argue for it. I'll also argue against it. And it just didn't feel like the best thing to do on that day. Maybe that changes next month. I have no idea. And then the last one that we passed was this one. And similar reasons, it just didn't feel right, which is hard to really explain logically. It's just, it's a feeling. But if I look at the discount, if I'm arguing that buying the discount or buying it when the discount is better than the average, then 9 3/4 is close to 11 and a half, but it's also not below, like it's not greater than 11 and a half. So there's that aspect. It's also, it pays on a quarterly scale. They just increased the dividend again. So, there's a chance the dividend actually, the overall yield goes up. But in, all of these funds, we missed the ex-dividend date for January. So that's fine. The first payment we'll get is in February. But for ADX, we wouldn't get a payment until May. And that doesn't bar it out from a future investment, like maybe in March or April. But for right now, it felt maybe not wasteful. That's probably not the right way to put it, but it felt off spending almost 4 grand on something that we're not going to see a dividend for at least 3 months. I'd much rather pick up a different fund with a consistent dividend and get a dividend every month in between now and if we choose to invest with it later. So as it stands, this is the new portfolio at Fidelity. If I can do it, I'm going to move this portfolio and join that other portfolio at Fidelity. That'll make keeping track of money overall a little bit easier on my family if something were to happen to me. And if we can do it, we're going to move the Roth as well. It still doesn't solve the problem overall of transferring money into the Roth. As far as I know, I've got to transfer it out of the individual. Maybe Fidelity's set up differently. Webull is I have to transfer it. So I have to sell it in the individual, transfer it to my bank, transfer it back into the Roth on at Webull. Maybe Fidelity's different. Maybe it's not. I don't know. Uh, but having everything under the same overall management umbrella, on my end of things, buying and selling and tracking doesn't really change everything, but it would simplify the system for whoever has to take this on if something were to happen to me. So the part of being, from my standpoint of things, having had family members who've died, and I mean, watching and learning in the sense of, watching an attorney track down all the different bank accounts and all the different assets and having everything so scattered, I don't want to do that to my family. But it's also on, the leadership, the captain side of leading my crew. I want to make it as easy for them as possible, and that means bringing everything under the same umbrella. just so it is easier for them to manage. Um, so we'll see how that goes. Um, there we go. So this is what we went with. I mean, I've gone through the four that we didn't pick, as well as what we did pick. Um, we'll look at. I mean, I don't know. I mean, it would be nice in ways if we had a giant shakeup. It's different funds, but quite honestly, the game is to do the best thing for the long term, right? So if every video I made was picking the same three funds or two funds every week, then it's doing the same thing. And I don't like monotony, but at the same time, it makes it easy. I mean, it's finding the best deal in the current market for the long term, right? And then penning your strategy when that long term cycle ends. Like when oil looks like it's finally going to stop running, or energy transfer and all that looks like the cycle's finally coming to an end, then it becomes either A, you sell and you take your profit, or B, you ride the dip roller coaster and then you buy low on the dip and then wait for it to come back up. But honestly, of what I've learned, I don't like riding the roller coaster. The roller coaster sounds fun. It sounds fun to buy the dip and then wait for it to hit the crest, right? And then ride the dip back down, buy low, and then hit the crest again. But honestly, I would much rather just buy the dip and hit the crest and then not experience the second dip, because we bought knowing that it would be a roller coaster ride for the stuff in pink. And based on track record and based on current goings, based on track record, both should have hit that next rise a lot sooner than where we are. And it's not fun waiting for the next rise. It's like you have that hopeful anticipation, but all the little bumps and hiccups and golf ball dimples along the way are just not fun, because it looks like it ought to just swing back into the next high, and it hasn't happened yet. So I like it. It would be highly tempting. Like honestly, these are some of my favorite funds. It would be highly tempting to ride the roller coaster through these things, but it would also be tempting, knowing my experience, to, when these hit the next high, pending on dip, but really when they hit the next high, it would be tempting to take the profits, wait and see where the market went, and then invest into the next thing. I think Brett Owens is accurate in that we get so part of it based on what we've been taught, but also just ease. Like we get so focused into keeping our stuff where it is that we almost get to a point where we hurt ourselves. Like if we move from but if we move from the idea of buy and hold, then you hold it no matter what and wait for it to come back and all of that. If we move from that mentality into almost like a swing trade, where you're buying and holding, and then when it hits the high, you're selling, and then you're rolling that money forward into your next investment when you have the opportunity for the next investment. And you can advocate for both. Like I think there's a good argument for buying and holding certain funds and then adding to those funds throughout your lifetime of owning a fund. Pending the fund, pending the current strategy, the current market, I can get that mentality. But doing it for every single fund, especially cyclical funds like oil and energy transfer, and real estate, might not be the best thing, right? But if that's your strategy, then know your strategy, or maybe pending your strategy, be willing to listen to somebody else, have your strategy be tested, and then either adapt it or tweak your strategy. I mean, whether you adapt it and keep it much the same, or whether you tweak it and adjust it to the time, It's still up to you, but don't get so focused and locked in that you're unwilling to do what needs to be done. And that's kind of the fidelity thing. It's we got to a point with our previous account manager or wealth management advisor, where we debated about it for years, but it got to a point where it was we have to do something. And it's going to be scary because it's going to be different, but we have to do something. Otherwise, we're going to keep losing money. And that's just not an option. That's not helping us. And it's also in moving these funds under the same umbrella. It's now that we have a Fidelity account and I see the other abilities we have with Fidelity, like a custodial Roth that is not offered at Webull and was not offered with Morgan Stanley, or a self-directed IRA, which is not the same SIDIRA of Morris Invest. It's not that, but just being able to self-direct your own funds. Um, Not an option at Morgan Stanley. And Webull offers it, but they just don't offer as much as Fidelity. It's one of those things of it. Like I like Webull, but at the same time, it's just one of those things where we need to do this, and I need to make it easier for other people. So that's really all I got. It's the same. It's the same overall um, closed-end funds investment for the week between FCO and HFRO. But honestly, anything on that list I can advocate for. Almost anything on that list I can advocate for. It's still a bonds market. It's still a utilities market. Still an energy transfer market. Still a real estate market. All depending upon discounts and maybe what's already in your portfolio. Maybe what the best dollar cost average move is for you. On our end of things, we're not buying anything tomorrow. I've been waiting for all of the end of month uh, dividend payments to settle, and then I can do a transfer of assets from one to the other, and then start to move funds over. Uh, let's see, and then plus we just bought our last round of investments, so I really don't have any plans to invest next week, unless I mean if we get some kind of crazy tech bubble where we really see the market significantly dip or tilt back into extreme fear, then that might change my game plan. But we will see. So that's really all I got for the week. So I wish you a great week. Uh, I wish you a great week. And regardless of where you invest, know your strategy, know the reasons behind it, be able to explain it to somebody else. And they may or may not agree with you, but at least be able to explain it to somebody else and have a logical discussion with somebody so you're not just buying on feeling. Like I love certain fund. I love the DSL fund, but it's really hard for me to buy it when it's in premium. So if you're having to really convince yourself to do it, it might not be the best thing. Um, Going forward, I've gone back through to work on both the video, and then I'll probably end up writing something about it to where I can make a case for closed-end funds that really walks through everything. So I will continue working on that, and then I'll make that video whenever I have it ready. Otherwise, if you have questions, comments, I guess concerns, but if you have questions, comments, and concerns, by all means, post it on the video. And anything else, I will see y'all on another video. So have a great week, everybody. Talk to you later. Bye bye.